So, hi everyone. Welcome to the 10 Steps to Home Ownership. My name is Gary. I'm with Homesmart Realty, and this evening's guest speaker, will be Myron Chamberlain from Prime Lending, who's going to talk about, guess what, the 10 steps to home ownership. A little bit of housekeeping just quickly before we get started with Myron. The first one is if you have any questions at all, any concerns, use the chat box, and I'll be able to answer from there while Myron's giving his talk, so we don't interrupt his flow. Second thing is that you will be receiving a free buyer's guide at the end. There's a short form that will pop up at the end of the webinar. Please fill that out and we'll get the buyer's guide over to you. It's very informative. It's about 30 pages and comes from our friends at Equitable Title. The one other thing I'd like to address is, I'm sure you've seen that for attending tonight, you will receive a $25 restaurant.com gift card. Now, there are a couple of conditions. They're not too heavy, but basically you have to be a US resident. If you're not, you won't get one. Sorry. Also, the other thing is you must give us, when you fill out the form, a verifiable phone number, one that you actually answer, or at least as your voice on the voicemail, something like that. That would be good, and a verifiable email address. So after all that, let's go over to Myron. Myron, you have the floor. So please begin.
All right. Well, thank you, everybody. Thank you for joining and spending your evening with us. It's such a delight to be with you. And there's nothing I enjoy talking about more than owning a house, real estate, investing in real estate, and the like. So thank you for joining. We here are in Arizona, and I guess I'd like to encourage everyone, if you have the chat open, just to get a sense of where everybody is from. Are most of those on the call locally here in Arizona? Or what, maybe in the chat, just put the farthest distance that you are from Arizona. I'd be curious to know where in the United States everybody is from and tuning in from. It might help a little bit in the content that we discuss here tonight. So if you have a moment, put it in the chat, and love to know how far the farthest person is here from Arizona. So, all right. Let's see, Gary, do we have anything going in the chat yet or not?
Well, the chat was actually disabled, so now I have enabled it. So hopefully we'll see some messages pop up.
Oh, okay.
So that was my bad.
Tuning in from Florida, Atlanta, Georgia. Nice. I think the Florida's got the distance award. Oh, another Florida. So that's great. Florida and Georgia are both great markets. I love them both. I own property in Florida, Texas, Minnesota, Arizona. All right. We've got everywhere covered. Midwest and Illinois.
I think we have.
That is awesome. Oh, there we go. Someone from the West, California. Oh, Connecticut. Okay. New Haven. I would say that's probably got the distance award there. So awesome. Everyone, thanks for joining. That's great. Thanks for sharing that. So we're going to talk about the 10 steps to home ownership, how you can do it. I think it is something that is much closer in reach than maybe a lot of people think about. I've been in the home mortgage and finance industry for 16 years. This is all I know. And I have seen people buy homes that would surprise you. Many times you do not need the credit you might think you do. You certainly don't need the down payment you might think you do. And the job history, we can discuss that as well. So it's going to be closer than one might think. And I want to just give that as a sense of encouragement to everybody, is set a goal for yourself as to when you want to own your first house. And it's such an accomplishment, and not to mention financial reward by doing so. So hopefully we'll talk here for 30 minutes. We're going to keep timing sharp. As always, we're open for questions. Put them in the chat and Gary will interrupt me and we'll make this happen. So 10 steps to home ownership. Let's talk through a few different concepts here. And what you'll see here is I'm also happy to share this presentation as well. So feel free to make notes, but if you'd like, we'll just send it out to you afterwards and you're welcome to hold on to it. So The first step is really determine if you're ready. And I would assume everybody, by being on this phone call, is probably there. They're clearly thinking about owning a home. There's a desire to own a home. And my guess is you've probably seen a lot of people own homes that are either primary residences or investors that you know and have had a lot of financial reward by getting into real estate. And that's exactly what we want for everyone on the call. Second step, I would say, is really calculating what you can afford. And I think the best way to target that is make a family budget and look at what you're currently paying for rent. So take an example of what the monthly rent is, and maybe look over the last 2 or 3 years, because if it's anything like Arizona, rent goes up about 5% a year. So if you're paying $1,000 this year, next year you would expect that to be $1,050, $1,100, and so on. Rent always gets more expensive because it's tied to inflation. It's called rent inflation. And so start by looking at rent and saying, based on our budget, now that we're renting, do we have money left over or not? And if you do, determine what it is left over, and your rent plus what's left over is essentially what's available for a comfortable mortgage payment for you. Step number 3 would be saving for the down payment. And with that, as a rule of thumb, most states have assistance programs to help you with the down payment. I always tell people, if you're looking for just a round number to say, how much should I have in the bank before I even consider getting pre-qualified? That number is going to be between 4,000 and 5,000. It's less than you think. You will need some money for the upfront deposit, the appraisal fee, and a few things like that. But 4,000 to 5,000 is going to be your target number before you get pre-approved, which leads into step 4, getting pre-approved with Prime Lending or another lender. The process is free. It takes less than a day. Once you've done so, you'll know what you're qualified for, what the payment would be, what the loan types would be, and it really positions you well for beginning to look at homes, which takes you into meeting with the realtor, beginning house hunting, making an offer, and then we'll go into these concepts a little bit more towards the end in terms of your inspection, appraisal, walking through, and then closing on your new property. So what I want to do is just talk through a little bit about renting versus owning. And if you're in the chat, you've got it open. If you own a house, feel free to let us know that. And if you're renting, let us know that as well. I would expect out of the 33 people or so that we've got on the call here that most of them are going to be renting, and they're on the call because they're looking to own. And so what I want to show you here, let me just see if I can pull it up, is a quick Excel spreadsheet that I made the other day for a client. And this is a client that I think is a very, very clear example of the average person who is renting now considering purchasing. And so I want to just kind of go through, as you evaluate renting versus buying, why you would buy and why you would rent. So can everyone see the worksheet that's pulled up here with the numbers on it?
I'm not
Okay,
seeing
mostly renting. Nice. So yeah, we've got a lot of people renting, which is perfect. Beautiful.
I'm not seeing the spreadsheet, Myron, just so you know.
You're not seeing the spreadsheet?
No, just the PowerPoint.
Okay. Let me do this. Let me just adjust my screen sharing here. I might have to, okay, new share. Okay, how's that?
There you go. Got it. Thank you.
Beautiful. Cool. So this was an example of a client, and this client was renting. She came to us and she was paying $1,400 a month in rent. So you'll see right here in year 1, $1,400, that's what she was paying in rent. And she was discussing whether she should buy, because if she bought, her payment was going to be $1,886. And that was a payment on a house she was looking at and ultimately purchased. And so in her mind, she's saying, it's going to cost me almost $500 more per month if I buy versus rent. And that's the dilemma a lot of Americans are facing right now. Because prices are high and rates are high, your mortgage payment will likely be higher than what you could rent a home for, which makes it a more challenging question if you should rent versus buy. But what you must keep in mind is, as you look at this column, Rent every year goes up because it is tied to inflation. And everybody knows inflation right now is a very hot topic. And rent goes up on average about 5 to 6% a year. So after year one, this is in Phoenix, so it's at 6%. Your 1,400 becomes 1,480, 1,570, and at the end of 5 years, you're paying 1,767. And so if you compare that to what the mortgage payment is, one of the great benefits of buying versus renting is that once you buy a house, your mortgage payment will never go higher. It will only go down. So you can see it's still a little bit less than what it would be in year 5. It would be 1,767 for rent, and owning, she would still be paying 1,886. And so over the course of 5 years, you can see here, she's going to pay an extra $18,500 in rent. And when you read online and see articles, this is exactly where the analysis stops. Everybody says, do not buy versus rent because buying is more expensive. You can rent for less. And they'll say over 5 years, it would cost you $18,000 more. That's true, but that's only 25% of the equation. In order to look at the other 75% and what that is, you have to look at 3 other categories. So the second is the appreciation of a home, and homes appreciate because they are an inflationary asset, and they appreciate around 6% a year nationally. For those in Florida, that's going to be pretty accurate. Texas likely as well. If you're in the Midwest, those numbers are going to be less. Typically, you're going to be in the 1.5 to 2%, maybe 3% range. So these numbers here are based in the Phoenix numbers, which is this 5. After the first year, it'll be worth 217, 230, 240, and at the end of year 5, it'll be worth 274 over here.
I think you're freezing up, Myron. Okay. Let's just wait for a minute here, and hopefully Myron will be able to get back on again. All good? You're back? Oh, you're muted, Myron. You need to unmute yourself.
All right. Can everyone see and hear me?
Yeah, you're back. Yeah, I got the screen and I can hear you clearly.
Boy, I am sorry about that, folks. I have no idea what happened there.
It started to freeze, and then I kind of figured it was going to go, but you're back on, so
I'm
no
sorry.
worries.
Let's hope for a good connection here. And so you'll see over the course of 5 years, the same client would have earned $69,000 of appreciation. Now, do keep in mind that that only is realized when you sell the property, but nonetheless, it is money that you earn by owning a property versus renting. So that's category number 2. We're 50% of the way there. Number 3 is principal paydown. Every mortgage that is done right now has a principal and interest component, which means every month when you make it, part of the money goes to the bank and it is paid the principal down, and then part of it goes to interest. So over the course of 5 years, the principal paydown is $8,030. And then secondly, lastly, the last component is tax savings. When you own a property, typically people will itemize their deductions versus taking the standard deduction. So the standard deduction for most single people in the US in 2023 is $13,850. And in her case, by owning the property, her tax deduction went up to $16,500. So over the course of 5 years, she earned about a $3,000 benefit in taxes. So you can see if you add all these 3 columns up where she lost $18,000 by paying more for the house than what the rent was, she gained the equity, she gained the principal paydown, and she gained the tax savings. over the course of 5 years, she was $61,000 ahead by owning the home as opposed to renting. And so that's the power of owning a home. And you really have to take in the 4 categories in order to realize the full savings of that. So let me jump back to the PowerPoint here. And that's kind of an in-depth analysis on renting versus owning. So if you have questions on that, just let us know, and we'll certainly glad to pause here and answer any of those questions. And in kind of summarizing that concept of the renting versus owning is when you own a home, the value of the home goes up, not based on how much you paid for it or your down payment, but based on what the home is worth. And so, for example, if you buy a home at $400,000 and the real estate market goes up 5% in 1 year, you'll have made $20,000 because the home next year will be worth $420,000. Very few other investments offer similar returns. If you were to invest in the stock market, as an example, you would have actually had to put in the $400,000 into your stock account in order for you to earn a 5% return on that. And so that's the beautiful thing about real estate, is your return is not based on how much you've put into it, but rather what the home is worth. And the other point that's worth noting on that is when you look back over the last 75 years, the number one concern people have is that we're going to have a 2007, 8, or 9 segment again where home values plummet. And there's real concern about that. I think it's a legitimate concern. But over 75 years, there's only been 6 years where that has ever happened. And those 6 years were 1991, 2007, 8, 9, or sorry, 2006, 7, 8, 9, 10. So you only have really 2 different segments over 75 years where the value of homes has gone down. It's always either been 0 or strongly appreciating. So I think it's a very safe investment once you purchase a home. Okay, so number 2, do the math. We talked about this a little bit at the beginning. Really what you want to focus on here is look at the maximum that your family budget is going to allow for. So take into account your rent. Your utility cost is going to be very similar when you own a home versus renting. It's going to be within about 10 to 20% on utilities. So you can call that category the same. And then you want to look at how much your budget offers remaining in your budget, so you can add that to what you're paying on rent. So if you're paying $1,000 a month in rent and you have $500 a month that you've been putting away to savings, you may look at that and say, well, I don't want to take all of our extra money and put it towards a mortgage, but I want to take part of it. So maybe you take $300 out of your $500 extra, add that to your $1,000, and $1,300 becomes your new family budget. So sit down, look at what you can afford. And a really good rule of thumb right now, and this varies a little bit market to market, but your mortgage payment for every $100,000 that you finance, your mortgage payment is going to be approximately $800 per month for every 100,000. So if you said I can afford a $1,600 payment, that would mean you would finance about 200,000. So 100,000 equals $800 a month for a mortgage payment, and that 800 would include the principal, the interest, the taxes, and the insurance. So that's your complete and total mortgage payment. Make sense? Okay, so that's the math. That's the mortgage payments. Let's move into a credit. So in the chat, tell me what you think the minimum credit score would be to purchase a home. See if anyone has a close idea as to what that would be. To give some perspective to the issue, credit scores begin at 350 and they go to 850. So 850 is the highest, 350 is the lowest. We've got a couple answers here. We have someone saying 600. Anchor's saying 730. We got another 600. The folks that are saying 600 are certainly the closest. It's actually a little lower than that. So 580 right now is the minimum credit score that you need to purchase a home. So 580 is the minimum, and credit scores work in different tiers. So generally speaking, if you're between 580 and 620, you only need 3.5% down to purchase a home. So if you buy a home for $200,000, you're going to need $7,000 as a down payment if your credit score is between 580 and 620. If you are 620 or above, chances are really good that you qualify for down payment assistance. If you qualify for the down payment assistance, you will only need a minimum of about $4,000 to $5,000 to purchase a home. That's it. So when you look at what a credit score is made up, I'm just going to touch on two categories here for you. And on those categories, I'm only going to touch on 2 out of the 5 because the 2 that I'm going to discuss make up 65% of your overall credit score. So the first is what's called your payment history. And payment history is going to be if you've made your payments on time. It's really as simple as that. And so if you have a credit card and you've had it for 2 years and you've made all 24 payments on time, your payment history is going to be absolutely perfect. If you have late payments that exceed 30 days past when the creditor has said it is due, and you've missed those payments, your payment history is not going to be fine. The reason it is so important is that payment history is approximately 30% of your overall credit score makeup is your payment history. And so it is so important to have that payment history on time. And you really want it on time for the last 12 to 24 months. If you've got late payments, but they're in the past, not a problem. As long as the 12 to 24 month payment history is on time, that is what's going to give you a credit score, the highest number and the highest possibility of purchasing a home. So that's payment history. The second is what's called available credit. And think of that as a balance to limit ratio. All that simply means is if you have a credit card for $10,000 and you go out this weekend and buy new furniture and the furniture costs $5,000. Well, you're going to have used half of your credit up on that furniture. So your credit to limit ratio would be 50%, meaning your debt has been 50%, the limit's 100%. And so on your available credit, you want to target any revolving account. So any credit card account, you want it to be at 33% or below of the available credit limit. So that is 35% of your credit score. So between your payment history and your available credit, that's 65% of your overall score. You're going to have a fantastic score if just those 2 things are in place. So that's what you want to focus on. You also want to keep the 580 number in place. That's the minimum credit. And then also have your target be 620 so you can capitalize on down payment assistance and you need very little of your own money. All right, so that is credit score. Next, going right into that is down payment. So a lot of people call us, not every week, but frequently, and they say, I want to buy a house, but I just don't have the 20% down. And they feel as though they need to wait for a year until the 20% comes to them. That is a myth, it's fact, it's fiction. Not even close. That's typically what your grandparents will have told you to do because that's what they did. And it's a fallacy that gets passed down from generation to generation. If you want to be in a really, really good position to buy a house and look at your first home, all you need is 3.5% of the purchase price. So do not forget that number. 3.5% is the target number that you want to plan for in purchasing a home. All right, so that's the down payment amount, saving the money. Loan programs. This is another area where I feel like a lot of borrowers get tripped up on the loan programs. And there's a lot of reasons for that. If you just open up Google and say first-time home buyer programs, you're going to get 6 million results of every different program under the sun. And it's very, very difficult as a consumer to navigate those because you feel like all of the programs are different. I'm here to tell you they're not all that different. They're different because every lender markets them as something different, but there is really only 4 types of primary programs that are done by every lender in the US. And all those lenders are going to package them up and market them as something different when really the underlying product is the same. So what those are is the first one you have is FHA. That is what we've been referring to a lot in this phone call. It's called the Federal Housing Administration Loan. It is backed by the government. They have very flexible and low credit score requirements of 580, and you only have to put 3.5% down. That is without question the #1 program that first-time buyers are using is called an FHA loan. VA loans are, again, another government-backed program, but the only way you can do that is if you're a veteran or if you're active duty in the military. If you happen to fall into one of those 2 camps, you don't need any down payment. It's completely free of charge, and it's a phenomenal program. USDA is one that gets very little recognition, and the reason for that is it's not eligible in a metro city. You have to be in what's called an agricultural or rural development town, and that's defined by a town that has 20,000 people or below. So if you live in a small town or a small suburb of a city that has 20,000 people or less, chances are you may be eligible for USDA. And that is a program where, again, you need no down payment. The interest rates are fabulous, and it is very, very affordable to get into a home. There is income limit, so you have to, in Phoenix, you have to be below 110,000 for your total income. But if that's the case, you will likely qualify for a USDA loan, and that could be a really, really good solution for you. And the last 3 that you see here, the Home Ready, Home Possible, and the Neighborhood Edge, those are all conventional loans, and they're typically reserved for first-time buyers who have a credit score of 700 or above, and they're looking at a down payment of 3% or more. All right. Question of pre-qualification versus pre-approval. And for those that don't know, there's 2 types of qualifications you can get. One is called a pre-qualification, one is pre-approval. Every state does things a little bit differently. In Arizona, we use a pre-qualification form. In California, you bet that they're looking for a pre-approval form. So it is a local custom as to which one you're going to get. The difference between the 2 is that a pre-qualification is simply a lender having a verbal discussion with you, pulling a credit report, possibly collecting a pay stub or a bank statement, and giving you their best guess on if you're going to get the loan or not. It's pre-qualified through the lender or the broker themselves. A pre-approval is much more robust, and that is actually started in the same way, in that you speak with the loan officer, you give them an application and send them your documents, but the loan officer then sends your file to underwriting, and underwriting pre-approves you. So they give you a conditional loan approval, and that tells the realtor and the seller who are selling the property to you that you've already been in front of an underwriter, and any potential issue they see will have already been addressed. So it's more robust. If you're looking to make your offer stronger, request the lender give you a pre-approval, not a pre-qualification. And this here is just a neat little checklist to show the difference between a pre-qualification and a pre-approval. And you'll see here to the column on the right, a pre-approval is much more robust than a pre-qualification is. All right, and loan options here. You'll see on these loan options that they're very similar to what we've spoken about before. They really give you an overview of the conventional and the FHA loan. But a couple of points that it adds here is that it shows you what a fixed rate loan is and an adjustable rate. The loans that are being done today are predominantly fixed rate. 98% of all loans are fixed rate. Very, very few are adjustables. I don't think I've ever had a first-time home buyer use an adjustable rate mortgage. And so it's good to know that they exist, and in some instances, they may be advisable. But 98% of loans that are being done right now are fixed rate loans. And the product you're going to want to focus on as a first-time buyer is what is called a 30-year fixed loan. Okay, moving right along. We've got 2 minutes left, and I think we're going to end on time, and then we'll open it up for some questions. So, set a meeting. So once you've gone through the pre-approval, you know what you're qualified for, what your payment would be, and the type of loan. That's when you're going to want to reach out to Gary and give him an idea of the type of home you're looking at, or the local expert in a market that you're in. Gary has lots of connections with realtors that are out of state, and he could certainly put you in touch with someone that is a first-time buyer specialist. And that's really what you're looking for, someone that understands your needs, your desires, the type of home, this area of the city, and what's going to be the perfect solution for you and your family. So that's the step that you do, and typically that's done 24 hours after you get pre-approved. House hunting, that's the fun part. So that's where you and the realtor get to go out on Saturdays and Sundays and look at different properties and say what you like, what you don't like, examine school districts, backyards, if it has a pool, if it doesn't. And really, it's your chance to become an expert on the homes that are available and really find something that is ideal for you and your family. That's one of the funnest parts of the home buying process. The next section is making an offer. And so that's where you'll use the pre-qualification or pre-approval that you've received from us as the lender. You will discuss the offer price with the realtor, and you will make the offer on the property. Typically, an offer is made, a seller is going to reply within 24 hours. And if you counter back, it would be an additional 24 hours. So from start to finish, it's typically a 1 to 2 day process for you to negotiate the terms of the contract. Once the contract is accepted, it'll be sent to either an attorney's office or a title company. And there's a term called opening escrow. So that means it's an official contract. Escrow is opened. And when escrow is opened, you've got an official contract between you and the seller. And from then to when you close and get the keys, it's typically a 30-day process. So your average home buying time frame is about 30 days. During that 30 days, you'll get an inspection, you'll get an appraisal, and both of which are going to cost you money. An inspection is going to cost approximately $400, and appraisal is going to be approximately $500. The inspection is going to look over everything from the roof to the drywall, the flooring, all of the mechanicals, and tell you if it's a property worth purchasing. And the appraisal is going to tell you if it is a home that is worth buying, because they're going to drive the neighborhood, look for the most similar properties, and give you a valuation of the home. So that's ordered by the lender, and that typically happens within the first 10 days. Right before closing, the day or two before you're all excited to move into the new house, check it out and get your keys. You're going to have a final walkthrough with the agent, making sure that it's in materially the same shape as it was when you agreed to. And this is one step that cannot be discounted. I see it quite often where just recently I had some folks from our church buy a house, and they did their walkthrough on Sunday night. They bought the house Monday morning, and They signed at 9 o'clock. They had the keys by 11 o'clock and went back to the house, all excited to move in. And they realized a whole bunch of the roof shingles had fallen off. And there was a storm that had come through Sunday night after they saw the property and they bought the home. It was theirs and it was damaged. And so those type of things can happen. And that's why it's important to do a walkthrough right before you take ownership of the property. Last and final step, closing on your loan. You'll take ownership of the property. You'll begin moving your stuff in, and that's really where the party can begin. So that is the closing process. And the last slide here is with our information for you to reach out more. We're very informal in how we like to interact with our clients. And so you can call, text, or email us anytime. And whether it's just a question, an idea, or whether you want to get pre-approved, please let us know. And that is something we would absolutely love to help you with. And we are always here to guide you through the process. There's nothing that Gary and I would love more than to see everybody on this call purchase a home in the next year and really reap the benefit of all of the appreciation that home ownership gives you. So thank you so much for watching. And we have the chat open now, and we can certainly go to questions along the way.
Yeah.
And anything else that you'd like to address?
We can unmute you if you like. If you prefer, you can just type a question into the chat box and we'll be happy to answer it for you. I was thinking about something actually, Myron, regarding how much return on investment it is to buy a home as opposed to renting. At what level do the payments kind of approach parity? Is there some kind of, is it like on average after 10 years or whatever? Because if we go by the rule of 72 and, the rental inflation's 7.2%, for example, every 10 years, that rent's going to double, right? At that rate.
Yeah.
At some point, it's going to be cheaper to actually buy.
Yep. So that's exactly right. So the rule of 72 is such that your interest going into 72, the number of times it does, it will double. And so if rent goes up, for example, at 6% a year, which it does in Phoenix, that means after 12 years, it's going to double. And I think that's true. If I were to look at rents today in Phoenix, there is a lot of rents that 12 years ago, you could rent a house for $500 or $600. Today,
right,
$1,200 is a minimum price point. So rent is going to double about every 12 to 15 years in the city that you're in. And it's true. Just ask your parents what their rent was when they rented their first house, and you'll find that it never stops going up. So right now in Phoenix, it's about 5 to 6 years. So within 5 to 6 years, your mortgage payment will be less than what your rent payment is. And the piece I didn't address was the refinance opportunity. So within 2 years, most people that are buying today will refinance. They're going to save about 10 to 15% on their payment, which is going to be between $200 to $500. So I actually believe that most people will have a lower payment within 2 to 3 years as opposed to what they do today.
It's interesting times because obviously we can't, totally predict what's going to happen, but judging by the news the last couple of days, interest rates are likely to at least stay fairly stable or go down, one would hope. Obviously, we can't say that for any certainty, but if that happens, this could be a very interesting time to actually get into a home because you've got less competition at the moment. Because once the interest rates drop, you're going to have more people out there looking for houses. You can get in now and with a bit of luck, refinance in a couple of years. So.
Yeah, Gary, there's no two ways about that, is that it's been projected that when rates go back to 5%, there's 5.5 million people ready to jump into the housing market. Well, we only have about 4.2 million existing home sales in the US every year, plus 600,000 new home sales. So that means you've got more than 1 year of pent-up buyers ready to jump in the market when rates hit 5%. We know if that happens, when the demand exceeds the supply, prices are going to go up. So we're going to see another significant increase in prices when rates go down because we're already short on the level of inventory that we need for a balanced market. So you are far better off buying today, refinancing when rates go down.
Yeah, I think so. I think so too. We'll see how it pans out, of course. But yeah, the news did look more encouraging in the last few days, I must say.
Yep.
Hopefully,
Yeah, we're starting to see the trends of that working through the economy.
I think so. Well, if does anybody else have any questions at the moment? I put up our contact information on the screen. Myron, do you want you can put yours up again in case someone wants to reach you?
Yeah.
Yeah. And we appreciate it. Thank you very much. That was very informative indeed. And if anybody has any questions they think of afterwards, which is something that I tend to do, then by all means contact Myron or myself. Even if you're not in Arizona, we can still help you. As Myron mentioned earlier, I have an extensive network of agents throughout the country, throughout North America, actually. So I can always refer you to somebody in your area. I don't know, I'm presuming that works in the same kind of way with you, Myron, or do you?
Yeah, we're licensed in all 50 states.
Oh,
So
you are?
irrespective
Okay.
of where you live,
Excellent.
I can
Okay.
certainly assist.
There you go. All right. Good to know. Well, thank you very much, everybody. And we will have a recording of this, which we'll shoot over to you afterwards. Please fill out the questionnaire at the end. And yeah, if you need anything, let us know. Always happy to answer any questions, help you any way we can. So thank you, Myron. That's very good. And I'll speak to you soon as well.
Okay, wonderful.
Always.
Well, thanks again, everybody. Cheers and all the best.
All right. Thanks. Bye for now.